Investors snap up €5.5 billion of Italian bonds at auction, no doubt in the knowledge, or at least heavy expectation, that ECB President Mario Draghi will follow last week's words with action this week. I'm Jamie McGeever and this is today's Market Pulse. Well, let's get straight out now to Eric Wand, rate strategist at Lloyds Bank WBM. Eric, maximum sold, lowest yield in 3 months, something of a success here.
Yeah, I think Draghi's effect has certainly worked its magic, at least for this auction, and I think a pretty reasonable set of results given the time of year. Okay, bid to covers were slightly soft, but I think you can ascribe that to participation rates. So I think the Italian Treasury will be relatively content with what they've received this morning.
And one can assume that most of this was probably from domestic banks.
Yeah, of course, there will be some international interest like there was at the bill sale earlier in last week, but I think predominantly Italy has been a relatively lucky place that its domestic institutional investors have been still keen to participate in their auction. So yeah, predominantly from a domestic account base, I guess.
Okay, lower yields, but on the 10-year at least, the difference from last month was only 23 basis points. Yield still around 6%. That can't be too encouraging.
Yeah, from a longer-term perspective, obviously, these levels are not particularly great. I mean, in the near term, Italy is perfectly capable of sustaining, paying these kind of rates. But from a longer-term perspective, it would obviously be keen to see rates at substantially lower levels, given the general macro backdrop. But that's I think at the moment, that's the best we can hope for in the near term.
So the Draghi effect, as you say, still at play. He really has got to deliver on Thursday. What does the market want to see? What will constitute success from the market?
From a market's perspective, I think they need to see something over and above the current toolkit which they have employed. I mean, there's a lot of talk about S&P purchases now. Yeah, that's all well and good, but I think the market will, if it's just pure S&P and nothing else alongside, I think the market would take that as a sign that it can sell into. So I think there needs to be something additional to the toolkit, and I think the tone of his voice recently has been, or the tone of his comments has certainly been that he does have something up its sleeve, which would continue this peripheral rally if it were to be a meaningful advance over and above what we currently have in place.
Okay, so dare I say it, is it time to go long peripheral debt here?
Yeah, well, you probably you could say you've missed the boat a little bit, but on the assumption that something big does come out and it's not just the same old stuff we've had before, then that could well allow the rally to run further and frustrate the consensus, which is sell into what it expects to be some kind of disappointment.
Okay, Eric, thank you very much. Well, today's main story in equities, HSBC. Europe's biggest bank posts a 3% fall in underlying first-half profit to $10.6 billion. It also sets aside $2 billion to cover legal and regulatory costs in the US and compensation costs for mis-selling in the UK. Its shares on something of a roller coaster ride this morning, down more than 1% after those results, then rebounding to a 10-day high of 538 pence. They were last around 535 pence, still up on the day, but underperforming European banks, which were up more than 2%. Well, that's it for now, but do join us at this time each weekday for Market Pulse, a snapshot of what's moving on financial markets and why. I'm Jamie McGeever. This is Reuters.